Hi, I'm Peter Lundgren, founding CEO at Lundgren's Capital.
And I'm Mel Lopez, Chief Economist for ASEAN.
Welcome to Sound Economies with Mel and Peter, an East meets West podcast by Lundgren's Investor Insights. Here we share what we're focusing at in economies and financial markets from the developed and the developing world. Hi Mel, how are you today? How's your week so far?
Hi, Peter. Hi again from rainy Manila. It's been the theme here in the past few weeks. Um, I've also been rained down by a lot of developments, financial markets wise, all over the globe. Of course, we know that tariffs have been the recent headline as well, but there have been a few stories here and there that have merited our attention. And of course, we talk about that here, Peter. How about you? How's the week for you so far?
Yeah, but it's busy. Great. Been on the road, have had good meetings, and yeah, so can't complain. It's really enjoyable and good to be here in the program again, of course. Interesting topics out there, interesting movements around the world. We will start out in again this week in Indonesia and move on to the big China. China that focuses so basically China and the chips, as the semiconductors, so to say.
Mhm.
We will touch base on oil, probably an oversupply that is significant and that is absolute worse and for investors to notice and dive into why. And then we have a big change on our standing on Fed and the interest rate outlook. So that will be sort of in the end. And of course, as always, we have a look on how much sunshine we see in the financial markets, if that is at all. Interesting, big things today. Let's kick off in Indonesia, Mel. Tell us.
So, a very interesting development just a few days ago, last Monday in Indonesia. So, the president of Peru flew over to Jakarta to sign a mega trade deal between the two countries. So, it was quite quick. Considering the scope of the deal, it was to remove import duties or tariffs on 90% of Indonesian goods entering Peru, and also most of Peruvian goods entering Indonesia. So it's mostly on a deal that happened in 14 months. So that's very quick relative to other partnerships or negotiated deals in the past. It covers a lot from palm oil to garments to mining to
Mm.
food to agricultural products. And it's mostly a symbol or a part of a larger trend that we're seeing of Asian economies opening up more to Latin American counterparts. So this comes
Mm.
just 2 months after China hosted a forum with presidents and high-ranking officials from Latin America and the Caribbean. And now we see Indonesia and Peru coming together. Recently, there's also been headlines concerning wider ties between China and Brazil. So it's really a larger move to open up Asia to Latin America as an alternative to the US market now that they're facing tariffs. Indonesia isn't um, that heavily burdened by the tariff, although it will still hurt. Trump is imposing a 19% duty on Indonesian goods entering the US. But yeah, there really is this trend of a pivot to open up more to new partners or to expand trade to existing partners that are on the lower end of the shares. Now they want more shipments across these two regions. So it's an interesting piece that we are monitoring. So maybe there will be more economies in Southeast Asia or Asia in general that would be tapping more into the Latin American market. So that's
Mm.
also something that happens in parallel to trying to appease Trump, Peter.
Yeah, the interesting part is the steps that we see as an
Mm-hmm.
isolated and Indonesian Peruvian trade deal is not moving the world well, but it is important, and Indonesia is a big country. It's a huge country and has huge potential. And sort of our focus is we expect we'll see much more of either these as a really bilateral free trade
Mhm.
agreements, or a bit sort of maybe what do I know, ASEAN towards a batch of Latin American countries, whatever. Yeah. So we'll see much more of that, and that is good for global trade, ex-US. And what we actually are saying is that the world will move faster and faster again outside the US. So that is a key takeaway. Yeah. And then another thing that has been emerging since years, the old economies are very much centralized around the North Atlantic, as a
Mhm.
US, Europe, whereas the growth in trade and yeah, new friendships, that is actually across the Pacific. There's a lot of things that's happening, in particular between, as you say, Latin America and Southeast Asia, as a new trade ways, and extremely interesting, and more will come. So yeah,
Mhm.
that's just another step in the right direction. So congratulations for that. So that's good. Yeah. Okay. Let's move on to the heavy China. See what's going on there.
Yeah, so
Yeah.
actually, one of the bigger reasons that is being cited as the reason for the recent rally in Asian stocks, mostly Chinese stocks, is the extension, yet another extension of the truce between Washington and Beijing. So that was last Tuesday. But one more piece of that puzzle is really, which was kind of odd to me at first, was the news that Trump is allowing the exports of high-end um, semiconductor chips to China. So that's uh, your big names like Nvidia, AMD, Intel also. But the kicker here is that both Nvidia and AMD have agreed to um, remit 15% of whatever it sells in China to the national government, to the US government, which is a very odd thing. It kind of looks like a special, a very, very niche kind of tax paid to the government when you should really not be taxing your exports because that's where you make money. So it's a very surprising development. Even more surprising is that both companies agreed to do it. There are some quarters who say that it is actually illegal to charge as yeah, a two company specific tax, but it's in place. And it opens up about $5 billion a year. For Trump's administration to freely allocate to whichever priority they would want to. So it's kind of really a very peculiar position. Um, but at the same time, we've seen both the main stock indices in the US, so your big ones like S&P, Nasdaq, and Dow, up year to date and even in the last 5 days. And the tech subsector index is also even performing better than the main index. So I think they are celebrating both the news that yeah, the truce is extended, but also the chip exports high-end exports to China is back in place.
Yeah.
It seems like good news in the short term, but it also doesn't sit right that you're including an added cost to do business abroad, and it's very arbitrary. So it could very well set the precedent for other companies, not even sectors, but companies to be facing the same a requirement by the White House. So it's very odd. It's a very odd setup to me. I don't know if it's a good thing in the long run because it could very well be giving more reasons for investors to pull their capital away from the US if
Mm.
you think your sector or your company will be handpicked by Trump to remit
Yeah.
15% or whatever you make from China. So it's a very odd thing, Peter.
It is. It is particular, and and everything can happen under Trump. He is. We do not support his economic policy in the U.S., but he is particular pragmatic. That has to be said. And one more thing, I believe is that despite the rhetoric between US and China is tough and harsh now and
Mm-hmm.
then, I think there is a mutual respect from these two nations. They know there are two superpowers. These are the two.
Right.
And they respect each other a bit for that. They know there's a sort of a hate-love relationship because it's hard for them to maybe after all to see their own existence without the other part
Mm-hmm.
existing. It is a very strange relationship that is between these two superpowers, and this kind of of individual export tax for a company is truly it's amazing. But anyway, the story is interesting. It shows a lot about the relationship between these two nations. They need to accept each other somehow. That they are doing a lot of things to hurt the other part into a certain degree. That is obvious.
They have
So,
90 days again to figure it out, or at
yeah.
least try to figure it out how to coexist.
And the third thing is that the chips from this particular producer,
Mm-hmm.
they cannot really be replaced. They are so they are so particular that they are so much in demand,
Mm-hmm.
and you can as you it is also amazing, and that is actually a signal to investors. They are simply producing an AI chip that is extraordinary.
Next level, yeah.
Yeah, and that is interesting as well. So a lot of interesting aspects in this story. Uh, so yeah, so it's a great story, and really worth to also to keep an eye on and understand the thinking behind.
Mm-hmm.
Okay, let's move on in the world. As promised, we do a check at the oil pump because there is an oversupply of oil in the market, and there's a clear, a distinct oversupply every day. There's a bit interesting discussion between three heavy insiders about how big the oil production is. And the three insiders are, we know OPEC as the oil
Mm-hmm.
producers. Then in Europe, we have the International Energy Agency, or it's based in Europe, I would say, and that is called IEA. But in US, they have
Similar one.
they, they also have one, and that is called EIA. So that is the U.S. Energy Information Administration. So not to mix them up, and that could be easy. But they're pointing at there's no supply, and we can see the oil price is dropping, and that is of course particularly interesting when we talk about inflation. So there is obviously an inflation driver that is out of the market, and it's actually keeping inflation a bit on the low side. So that is obvious, and we can discuss why is there an oversupply? So why are the producing countries continuing to pump more oil up? As mentioned, there is a discussion about how big is the oversupply.
Mm-hmm.
It is ranging from one forecast is saying that so far this year, solely this year, there is an oversupply of more than 300 million barrels totally. And that is the EIA, the US guys. The IEA is saying that is a European-based one. They're saying it's like 225. Okay, that's not so far away, but OPEC is saying close to zero. There has been a drawdown on the from the storage. That is and that is probably why they continue to produce. But it's unusual. This is a big difference. And
Parity,
just to
yeah.
say this, that if the two first are right in the assumption, these kind of 200, let's say 250 million barrels,
There.
that actually equals 100 super tankers. Also 100. And of course, I know they're not lying in one line, but after all, it is 100, and that is visible. There's a lot of storage capacity also onshore as well. It doesn't have to be into super tankers, but it's a lot. It's a lot actually. The indicator is that the oil price will stay low for some time if these overproduction numbers are correct. And
Mm-hmm.
that is worth, again, also worth a study. As it can who's right on this in this game? It looks like oil will stay on the low side for some time. So that is interesting. That also gives us an sort of a jump
Mm-hmm.
to the next story we have prepared. So the next thing that is actually is really on the top of our whiteboard at Long Greens these days, and we disclosed the consideration last week. We would make sort of a deep dive into our stand on the Fed's interest rate policy.
Mm-hmm.
Have we have since long, as last year said, where the market was expected 2 times 25 basis point cut, we were saying no go. It will be simply staying flat, so to say, as a no change.
Mm-hmm.
And we have argued so since almost a year, but as a very actively, of course, this year, but basically also in Q4 last year.
Yes.
With the reason saying, okay, the biggest risk was the inflation upside. That was also the risk before Trump he went banana with his tariffs.
Mm-hmm.
But simply that inflation was not sort of under control very much under control, and there was such the upside risk. And there is still an upside risk on inflation. In US, it's hovering around 2.7% now, inflation. And you could say in the US, they also have officially a sort of a 2% target. In
Mm-hmm.
Europe, the 2% target is reached. But the Fed is much more pragmatic. And they have told us so many times they can easily live with a high inflation. They look a sort of bit more long term on inflation.
Mm-hmm.
2.7% for Fed is not a concern, actually. The way we see it, it is more the risk on the upside that has been a concern so far. But what has happened is the labor market data that came out last, and in particular the revised data from the 2 prior months, showing a somewhat weaker labor market than was announced first. So now we have a labor market that actually for 3 months in a row, all of a sudden is weaker than expected and first said. And if we go into different alternative information that we look at, all
Mm-hmm.
kind of how to say how are the consumers doing, how they're spending, how much did they use in Walmart last Sunday, and all this stuff. Yes, all kind of different research, and that's where US is fantastic. There's data about everything. Yeah, and obviously is a clear trend this year that all sort of restaurant chains, the large restaurant chains, and even in the US, McDonald's and the alike belongs to called restaurant chains, yeah. But that can also be chicken wing chains or whatever Asia box chains, all kind of a bit broad in
Yeah.
restaurant chains for where everybody goes. And they see all of them, each and every of them are saying they see a lower consumption.
Mm-hmm.
They see lower to lower. They see fewer guests. And it's across the country.
Mm-hmm.
And if you look into the McDonald's statistics that is referred to in the news, they even measure on um, the different household incomes, that how they are behaving as a consumer wise in the restaurants,
Yes.
meaning they can see that it is particularly low incomes in the US that are either simply not coming that often in the restaurant, in the chain, or they are trading down. Many of the visitors in all these chains, they're trading down in the way they are choosing cheaper menus, simply
Mm-hmm.
spending money every time
Okay.
they come,
Yeah.
or buying less. doing something, maybe going there, maybe not. And more people are actually purchasing food to prepare at home. That is also the statistic showing the same. So we are seeing the pressure spreading in US, and we have argued all the time that Trump, he will ruin the US economy. And this is sort of just steps in that direction. It is not sure he can, so that can control inflation, but right now, what will happen is that inflation is stable, but we are seeing economy getting softer and
Mm-hmm.
not even, it's actually sort of losing a bit ground, yeah.
Yes.
And the worst thing that could happen for Fed is if they are behind the curve and getting criticized for not supporting the economy. Now, that would not only be criticized from Trump, that would be a general criticism. And Fed is fantastic in being ahead of the curve. They are normally doing a very, very good job. And it will mean a lot for them to stay ahead of the curve and saying we are supportive to US economy.
Uh-huh.
That is why we are now saying in the sort of Fed thinking, it is time for change. And we call for a rate cut in September. And it's not only 25 basis point, we go for the full 50 basis point. And the reason is they could have cut in July. And why do I say they could have cut? Of course they could. But at that time, the latest labor market data, the revised labor
Mm-hmm.
market data was not. And it means they're sort of all of a sudden, if they wait another month and we see a fourth month in a row with weakening labor market data, then all of a sudden they come behind the curve.
That
And
would
it's,
be too
it's,
late.
it's yeah, yeah, and it's never good for central bank to be behind the curve. And this is why we say now, okay, we see that the economy, we think the economy will wait more than the inflation. And that is why we call for it. And we say full 50 basis point as a Fed are good in doing action. So this is what we call for right now. It's a big change in our stand,
Yes.
and we should and we should look into, okay, what does it mean? What do it mean? Would investors be scared away, saying, "Wow, they're cutting 50 basis points, sell out and sell everything what we have because they are seeing the dangers coming." I would say not. As of right now, what has happened after also, we're not the only one having this discussion. In the market is already now priced a 25 base point cut. And that has this adjustment has sort of happened the past 2 weeks. What we should see is all assets are already getting bought. Stock markets are up in general. Gold is up. Everything is up. Real estate is up. We are more looking into adding more fuel on the assets becoming hot. Yeah. So we would say it won't get the market nervous. We would more say it's people will simply buy more assets. As a, honestly, it's it will fuel more buying. Simply,
Mm-hmm.
this is how we see it now. Then when that has happened, we can start to discuss: is there a bubble somewhere? That might be a discussion, but it's not now. Yeah, it will actually more support a positive market. So this is what we see, and it's a big change for us. Yeah, so extremely exciting.
Yes.
It will also be exciting how much could it spread. Yeah, what do
Mm-hmm.
we think? What would Southeast Asian central banks, how would they react on that one? What do we say, Mel? What would happen
A lot of Southeast Asian central banks have been cutting already earlier this year, and it's mainly in reaction to softer inflation onshore or domestically. Rate cuts in the US would kind of keep them a little more competitive than before because, of course, Fed rates were so high relative to theirs over the past few months because the Fed wasn't cutting. But now that we anticipate that they would and in a big manner compared to what we were expecting really a few weeks back. It would be kind of challenging, but not really as well, because of course there is still really that big preference towards the US. There have been optimistic views towards Southeast Asia, but really they still do consider the US a safe haven. Maybe not so much under Trump, but still more stable than how they view developing economies in this region, Peter. So the central banks here always say that they act independently, but of course they still are very much reliant on what the US Fed does, Peter.
It will be interesting to see if they say, okay, we are already there, or they filter to cut a quarter here and there. That'll be interesting. But this will be, as it will be heavy interesting, the race in US up to the next Fed meeting, because it will be a race. A lot of things going to happen, and it is exactly in 1 month's time,
Yes.
because all of a sudden, a few weeks ago, the lady called Adria Kugler, a Fed governor, she
Mm-hmm.
resigned without any reason. She was appointed by Joe Biden. I don't know, but as she was a governor, she was a voter, and we remember that the last vote there was two people voting
Dissenting. Yes.
for cutting the rates, yeah, in July, and there are 10 votes. Now the successor for Adriana Kugler, that is of course a Trump selection, and that will be Stephen Maran. It
Miran.
is the PH, yeah, it's not a V. We're discussing, but this is Stephen, and of course he will be very supportive as a Trump's man, yeah. So we will get a
Yes.
voter that is for sure will vote for rate cut.
That, yes.
But the key is he needs to be approved before the next FOMC meeting, and there is a race going on to reach that. Yeah. It'll be great fun to see it. And then we have more and more of the FOMC members voicing their opinions, and as we also talked about last podcast, two of them who have been sort of most vocal, they are non-voters.
Yes.
Uh, but we had this week one of the voters, and he's called Austin Gooseby, but he's one of the hawks. So he was advocating for sort of a bit in the other direction. As he would very much disagree with what we have said today. He was still leaning towards a stable, as a no rate cut. So we will probably start to see some comments,
More.
more comments maybe within the next 4 weeks. Yeah. So it will really be a bit more. It's a fascinating race. There will be a lot of focus, a lot of attention, and yeah, it's just so fascinating, and it's so interesting. So investors have really something to look forward here to, and also to study. It could move the markets, of course. So this is important. So there will be somewhat of an event almost. Fantastic. Anyway, how does that influence our sunshine outlook, Mel? Are we happy?
We still see sunshine in the horizon, of course. Now that inflation is cooling for a lot of economies, not the US, but steady is better than rising. Um, and with the news also about the oversupply in oil, it bodes well for inflation, and that removes some pressure for most economic managers and central banks to lay off on keeping rates steady, or even allows them to cut rates in the next few months. So, including the US now, as we view it, as we explained just a while ago. So, it is showing that for most of the economies, or for the world in general, there is or there remains to be a position of strength as far as economies are concerned. There.
Also fundamentally, we like the world. We see the world as robust, and private consumption is okay, particularly outside Europe. And this probably increasing speculation about rate cut in September should support the markets even further. So right now we are sort of in this sunshine mood, basically, and that's nice. With that, we will say thank you to all the listeners. Thank you to you, Mel, for sharing your insight. It's been a pleasure
Thanks,
being here.
Peter. Thank you.
We will be monitoring global developments and will share what's interesting in the next episode of Sound Economies, Will and Peter on the Global Financial Markets, a podcast by Lundgren's Investor Insights. Thanks for tuning in. For expert insights on the go, download the Lundgren's Investor Insights app for free. For investors, we offer very exciting and high-quality alternative investment funds, including our top-rated mutual China fund. To know more, visit lundgrenscapital.com.